Testing, testing. All right, I guess we're rolling. All right, hey guys, this is Hala Pablo, and I thought we'd do a part two of the bear cycle anatomy video that we did yesterday, where we looked at XLM and we measured out the duration of the accumulation zones, aka bottoms, on the macro. And this is the chart that we looked at yesterday. It's the XLM USD stellar lumens, and it's like I said, it's a very good representation of. Here we have two almost cookie cutter bull cycles, and we have two bear cycles. One played out completely. That was the last one we had. We measured it out. It was 780 days, give or take, from the last sell-off that amounted to the primary support, and then culminated with the selling climax, and then went all the way to the end of the sucker rally, which what I call a sucker rally, and which is really the bull cycle has already started at this point, but it's just one last kind of FOMO pump where it comes back down and retests trading range support before we go up and we start the bull cycle proper. And so that was 780 days altogether. And then we looked at the anatomy. We looked at some of the common features that are shared in these accumulation zones, loosely drawn Wyckoff schematics, where all of them seem to have the primary support, selling climax, and automatic rallies, the upthrust after distributions with the higher highs and the series of higher lows. In this case, more often than not, I see the wedge. It's a wedge that expands. It's like a widening rising wedge, which is bearish ultimately on the macro. And so we see that here with the spread widening as the incline progresses in these wedges. And then at some point after the UTAD, the upthrust after distribution, the price action breaks through the structure, comes back down into the trading range, and remitigates the selling climax, which oftentimes goes lower than the selling climax, and which is what I call the terminal shakeout. That's a Wyckoff term. And then from there, at the terminal shakeout point, we begin the actual bull reversal on the macro. So let me see here if I could get a little brush here. So right here is the actual starting point of the reversals. So we saw this in the old accumulation zone that started in November of 18 and ended in January of 21, and so that encompassed the entire bottom between these two bull cycles. And then we had another bull cycle, the one that we just came out of, with the macro sell-offs starting in like April of 22. Well, it started before that, but I just counted from April of 22, which would be kind of the same area that we started here, which fell into the primary support, which culminated in the selling climax for this present bottom that we're in right now, this present accumulation cycle. And then here we drew out the same. We see the same kind of rising wedge. We see the automatic rally with the two secondary tests with the UT and the UTAD. There's a UTAD under here. I don't know if you could see that, but yeah, see, there's a UTAD. And so it was basically where we are, 780 days. If we were to draw the same duration, 780 days, that brings us to May of 2024, which is pretty much feasible. I'm expecting, like we talked about, just a quick recap, I'm expecting another maybe a little micro rally within the wedge, intra wedge. I don't know if we're going to go all the way up to macro trend resistance, but somewhere within the wedge, and then we're going to come back down like we did here. We're going to break structure. We're going to fall back down into the trading range, and at some point, I believe we're going to remitigate the selling climax just like we did here with the terminal shakeout. So I'm expecting a terminal shakeout that could fall below $16,000 Bitcoin, maybe 15, 13, who knows? And then from there, that will be the actual beginning of the bull reversal. at that point. But that's not going to be till next year, maybe May, April, May, sometime around there. And then we're going to have that last sucker rally where the price comes back down, retests trading range support, and then we start the actual bull cycle. So 780 days, give or take. Just because it took 780 days last time doesn't necessarily mean we're going to repeat that. Actually, that would, like I said yesterday, that would be kind of odd. Nothing is completely cookie cutter. Now, the features, the geometric features of the Wyckoff schematics, those are pretty much dead on as far as the wedges, the upthrusts, the coming back down, the ebbs and the flows, the counter trends within the schematic. There are, lots of similarities between the Wyckoff schematics that overall resemble an accumulation zone. You can see those features. But the duration, varies, and also the length or the depth of where the terminal shakeouts occur. Sometimes the second mitigation doesn't fall below the selling climax. Sometimes it just reaches a selling climax or it hits trading range midpoint, which would be the 0.5 Fibonacci. There's a Wyckoff accumulation schematic number 2 that only brings the spring down to mid range, and then from there we get the bounce, and then we go up, and that is that would be the beginning of the macro markups. So. But 780 days, more or less. And, that's just, I know we're looking at XLM right now. But if you go to another, if you say, okay, well, that's great for XLM, but what about like if we go to another crypto? So I thought we'd look at also, we'd compare this with Ethereum. If we go to Ethereum, I've already charted this out. Let's see what we have here. This is on the 3-day. I know yesterday we were going off the daily. Let me see if I can get rid of that. But here would be the Ethereum 3-day on the Ethereum, and we have a full accumulation zone. From here, we have this big double bottom on the macro that we had. Now, this started in August of 18, and I kind of drew the same lines like we did with XLM. With the macro sell-off that reached the primary support and then came down to the selling climax of that bottom. And so here again, you see the rising wedge, you see the automatic rally, secondary test, UT2, the second secondary test, and then it came back down, and we mitigated the selling climax again. You see, this is very important. In a macro bottom, there is a retest usually of the lows, the first low being the selling climax at the beginning of the rising wedge, which takes us up to the top of the counter trend. There's counter trends in these accumulation zones, and that usually amounts to what we call a UTAD or upthrust after distribution, where we get the wholesale distributions, where it breaks through the wedge, comes back down, and retests the selling climax, which is the support of the trading range, because we begin each trading range with the selling climax if you go by Wyckoff theory. So we have trading range support, trading range resistance, and then this constitutes the double bottom. So when we get that mitigation of the spring or the terminal shakeout, that constitutes the double bottom of the W on the macro, and then from there we have the tests and the retest. And you see, this is 781 days, because I went up to the sucker rally and we came back down to the test. This is exactly like XLM. So now, I found, like, if you go and you do your own research and you start measuring out these accumulation ranges, which, by the way, is very, very good practice. Just pick a coin or a token arbitrarily, or even a stock, and go measure out the bear cycle bottoms, and do it like we did it here. Or you could start at the selling climax and you could end at the spring and the mitigation point in the latter half of the range, and just start measuring those and just get a good feel of how long you can anticipate these bear cycles to last. In my experience, it's anywhere between 1.5 to 2 years. So this isn't something that resolves right away. We hit this UT2, and like a lot of people who don't know how to trade are thinking that this is it. We're going up. We're going to start the reversals are coming, only to end up buying the top and then coming back down and getting skinned alive. And then and oftentimes we go even deeper than the selling climax. And this is an accumulation or an absorption campaign by smart money. So they're counting on fear and greed, FOMO and FUD. And so but here, essentially, what they are doing is they are absorbing the coin and digging in deep and getting retail investors, aka weak hands, to capitulate, to sell their bags, and they're buying it at discounts down around trading range support. And here, smart money, institutional investors are establishing their positions, very deep, lucrative positions in anticipation for the bull reversals, which will take place. But here they are they're absorbing the coin. And so this was the old distribution, or rather accumulation zone for Ethereum between 2018 and, what did I say it was, 2020. And this is where we are presently. Excuse me. So we see here we're only at day 494. Remember, this is 781. So again, this brings us to a resolution of somewhere around April or May of 2024 before we see really something that resembles a macro reversal for the bull markets. So, but here we see the wedge is much more prominent. Why? Because there's a lot of manipulation now. Things are different. This is an unprecedented time for crypto. There's a lot of major players. The Securities and Exchange Commission is like big time in the game now. Wall Street is no longer sleeping on crypto. They are in the game. So yes, these measurements are going to be different. But like I said, essentially the features of the schematics, aka the anatomy of these bear cycles, are fundamentally the same, which means there's a rising wedge, there's automatic rallies, there's secondary tests and up thrust after distributions, all which comprise the wedge. They have to have this wedge, which is the buildup of the counter trend, so that more of these tokens, more of these cryptos can be accumulated deeply as they continue to absorb. And so those are the ebbs and flows of these cycles, which makes up rising wedges in anticipation of going back down, retesting. See, they want them to buy up here. They want this secondary test. This is why I'm not surprised if we go back up for another rally. And in fact, I'm anticipating $2,000 Ethereum at some point. But it doesn't mean that you buy $2,000 Ethereum thinking we're going up to $8,000, $9,000, and we're about to, we're kicking off another bull cycle in like November. It's just not going to happen after 480 days. At some point, there's going to be a sell-off. What's going to happen? Smart money, the composite operators, are going to sell into these pumps. As you can see in the volume, you see these big stoppage supplies, supply volume predominance. Even though the price is going up, we are seeing demand in the vertical bar volume going down, and even in the Weiss wave going down. So if this were a legitimate markup, we would see demand building along in correlation with the price action. But we're seeing the opposite. We're seeing divergence, which is a bear signal, ultimate bear signal. Remember, we're looking at the macro and the extreme macro in this case, 3 days. So anyway, all right, that's about all from me right now. I just wanted to do a little elaboration on the video that we did yesterday. If you enjoyed this, if you got anything out of this, like, subscribe, leave a comment. I'm going to try to leave I'll pin a comment up on top with my trading history that you can see for yourself. I have about 500 charts on on TradingView, on my Hala Pablo TradingView account. You're welcome to look at it. Like I said, I've got 80 to 85% win rates on there. You can go back and just inspect my entire track record, and you'll see that there is something to what I'm saying here, and there is a method to my madness in this. And other traders, other Wyckofian traders, volume spread analysis guys can also corroborate what I'm saying here and show you. And you could download and look at all the Wyckoff schematics that they have over macro, bear, and bull cycles, going all the way back to the 40s and the 30s and 40s, after the stock market crashes and all that stuff of yesteryear. So anyway, okay, thank you, and we'll talk again soon. Happy and safe trading. None of this is financial advice, but you already knew that, didn't you? Okay, well, thank you guys, and I hope to see you in the comments or in the trading group. Okay, bye-bye.